You have now borrowed some returns from the future. That's the reality. This is not the time to look at taking on more risk to, increase your short-term returns. So people keep saying, oh, but growth in India will be the fastest. Yeah, that's true. But then that is already captured in the valuation. We have much more comfort in large caps, very limited comfort in the mid and small caps, primarily coming from the valuations at which those companies are trading. We've been telling people, if you want to invest now, there's more sense in looking at hybrid solutions because they will help you address asset allocation. That equities are a very unique asset class in the sense that the upside can be very diametrically different from the downside when you invest, right? It has this unique characteristic where it allows you to create wealth over very, very long periods of time.
Hello everyone. Before we dive into what Samvat 2081 brings in for our investors, we are joined by Vetri Subramaniam here, who is the CIO of UTI AMC. Hello sir, how are you?
Delighted to be here, Deepthi, and to talk to all your viewers today.
So what's fascinating about his journey, I'll tell you all, is that he was one of the founders of Sharekhan.com, now known as Sharekhan by BNP Paribas. Also, he's been an advisor to a UK hedge fund, and he's been guiding the equity investments in India during 2003 to 7. So that's what makes him a special guest. So thank you for making time for us, sir.
Thank you. Happy to be able to do this.
So please tell us a little about your investment journey and how did your investment journey begin? What were maybe the kind of stocks or sectors you looked at? Do you hold any of them? How did you choose them?
So, I would say my professional career in a sense started not with investing because when I started my career in 1992, the Harshad Mehta meltdown was actually happening at that point of time. And as a result, I ended up in the only division which had business of my employer then, which was the Kotak Group, which was selling car loans. So it had nothing to do with investing. But thankfully, 2 years later, an opportunity came to move into investing. But those were the very early days, Deepthi. So there was no question of somebody being a specialist in one sector or the other. You just looked at everything that came your way. So I was very lucky because I started at a point where there were no rules. And therefore one could sort of chart your own path in terms of what you wanted to focus on because the team sizes were very small. And the other point that I would make is that it taught us to fight very hard to get information that we could use in our analysis to be able to look at companies. The big difference between today and 30 years ago is that 30 years ago we had to go hunt for information. Even getting the annual report of a company was a challenge. You had to queue up at the BSc outside the library to be able to get a copy of the annual report. Today, information is widely available. And really today the challenge is about identifying what is noise and what is information. Whereas 30 years ago when I started my career, just getting raw information itself was such a big challenge. So the entire investing domain has shifted over this 30-year period.
So also to go back to a little about how you began investing and what kind of stocks did you hold, and do you hold any of them right now?
Sure. Well, professionally, I was in a very different organization, very different role. That was actually a prop book. So we actually didn't hold anything for very, very long. There were a few investments that we had, but a lot of what we had was actually really in the nature more of a trading book. And then there was an investment book that went along with that. Personally, actually, I think I started out making all the classic mistakes that many investors make. I think in my early salaries, I first sort of experimented with punting in IPOs, but pretty soon realized that that wasn't really the way to go. But honestly, Deepthi, because I got involved in professional investing very early in my career, I took a decision very early on to not invest in stocks to prevent any conflict between my professional role and what I do in my personal capacity. So I have not bought a stock in my personal capacity other than employee stock options for almost about 20 years plus.
So I mean, you've seen the cycles of market. You've been in the market for over 3 decades, I believe. So how has the mindset of investors changed over a period of time?
I wouldn't really answer the question in that fashion because I think what is more interesting is that particularly in the last, I would say 5 to 7 years, there has been a huge influx of young and new investors into the market. As far as those who've been around for 30 years, I think the evolution is something which sort of keeps happening. But I think, to my mind, the more interesting change is this behavioral thing where suddenly in the last 5 to 7 years, investing in equity has now become an acceptable thing to do. In fact, people think of it as part of the strategic financial planning that they need to do in order to meet their long-term objectives. That is a very big difference, because I would say 20, 30 years ago, a lot of the people who looked at investing were looking at it as a get-rich-quick scheme, right? I'm not sure that mindset has fully evolved when you look at the data of F&O trading and options trading and all of that. Unfortunately, some of that is still there. But the reality is, when I look at the sheer number of investors who are now committing to long-term investing by SIPs, it suggests that equity investing is now mainstream. It is no longer seen as just something which a few people speculate in. And I think that's the big difference.
So can you also elaborate a little on what is the importance of long-term investing as compared to short-term trading or investing?
Good question. Look, I think a lot of short-term trading, and I've done that during my days as a prop trader, when I started my career, is really very much a zero-sum game. What you're playing with is daily volatility and daily fluctuations. Whereas when you're investing, the beauty of this is that your upside, over long periods of time, and I'm not talking about this normal conversation, people have 10 bagger, 100 bagger, I'm not referring to that. I'm just saying that equities are a very unique asset class in the sense that the upside can be very diametrically different from the downside when you invest, right? And therefore, because of that, it has this unique characteristic where it allows you to create wealth over very, very long periods of time. And I think that is why people should be looking at equities, because no other asset class can help you in that wealth creation journey. Now, as an investor, to achieve your financial goals, you will need to mix and match assets. Some assets which help you create wealth, some which will be available for a rainy day, some which will be available for a defined purpose, some which may form the policy of form an insurance policy of sorts. So you will need everything. But for that wealth creation angle, there is nothing better than equities, because it offers you that potential, which is a very significant upside as related to the risk that you are asked to bear.
And if we look at do you also see investors are becoming more conscious or probably aware of high equity valuations, especially given the recent spate of listings?
Hard to say, because what we've seen has been continuous sort of, inflows into the market. There's, huge number of supply coming through, as you said, by way of IPOs. We've not reached that point as of now where we are seeing high prices causing demand to slow down, right? I mean, the classic way in which you think about economics is that as price goes up, demand should come down and supply should go up, right?
But that
so far what I'm seeing is that actually as the prices have gone up, the supply side is doing exactly what I would expect it to do. More and more companies saying let's get listed, foreign companies saying let's get listed in India, Indian companies saying let's raise more money by selling shares, promoters saying I'm willing to dilute control, I'm willing to reduce my stake and offer you shares. The demand has not reacted to high prices as yet. Sometimes they say this is typical of stock market. It's the only place where the lure of higher prices causes demand to actually accelerate as prices go higher, unlike what it should in classical economics. So we'll wait and watch. But there has to be a price level at which demand starts to step back, whereas supply at that higher price should actually continue.
So basically, there's no nervousness with these big corporations about going ahead, especially those who are eyeing for an IPO. There's no nervousness to go ahead and get a listing on the bourses. That's what you mean, right? Or is there?
There's no nervous. Well, I think, look, honestly, to be fair, any listing is such a big event. I would be surprised if somebody was not nervous about it. But yes, I think what people are looking at in the marketplace and realizing that, look, there is demand, so I can bring a supply. Then it's a question of fine tuning what is that price at which you are able to get the demand and sort of meet your objectives as well. But I would certainly expect any company doing an IPO to be nervous. I mean, if they aren't nervous, then I would be quite concerned.
So essentially, they're okay with these valuations being where they
Without
are,
doubt.
and they're going ahead and getting.
I mean, that's what the data is saying, correct? I mean, I don't remember the year-to-date data, but we did this sometime last year. And if you look at the calendar year leading up to December, the total buying by foreigners and Indian funds was about $43-45 billion. The supply of PE, VC, fresh shares by way of QIP, IPO, etc., was almost about $35-36 billion. So, demand, yes, but the supply side is responding as you should expect it. But it would be a good thing, Deepthi, if at some point the demand function also slowed down, keeping in mind that the prices are high. We have not seen that as yet.
So basically, investors need to probably exercise some bit of caution.
So what we've been telling investors, honestly, and you alluded to this when you talked about valuations, we've been telling people if you want to invest now, there's more sense in looking at hybrid solutions because they will help you address asset allocation. The reality is that in the investment journey, you do not control the variables. You are dealing with things which are unknown. When you are dealing with things which are unknown, it is better that you focus on controlling what you can manage. You can manage your risk appetite, you can manage your asset allocation because it is linked to your financial goals. So our advice to people has been consider the hybrid solutions at this point of time. They will allow you also to stay in line with your defined asset allocation patterns. This is not the time to look at taking on more risk to increase your short-term returns.
So I mean, in the past Samvat here, we've seen Nifty giving robust returns close to around 30%. So what should investors expect for the upcoming Samvat?
So look, the harsh reality is that the stock market doesn't care whether it's your birthday, my birthday, Diwali or any of that. So all of that is immaterial. So first of all, never think about the market in terms of Samvats or New Year's. I think the simple point I would make is that you have now borrowed some returns from the future. That's the reality. So be cognizant of that in your asset allocation. Secondly, for you to expect, in my opinion, that you will be able to get returns better than earnings growth from this current starting point is a very dangerous assumption to make. Your best case returns would be equal to earnings growth, with the caveat that because valuations are elevated, at some point of time your returns could dip to below earnings growth simply because valuations start to normalize at some point of time. So, that's the thought process with which I would look at the equity markets at this point of time. If you're a long-term investor through the SIP route, keep going with the SIP. That's not an issue. Focus on your asset allocation. That would be my big message to investors because that is within their domain. That is what they can manage. They cannot predict what will happen in Russia and Ukraine, what will happen in Israel, and the fighting happening in the Middle East, what will happen in the US presidential elections, what will Chinese policy be, will there be a Cold War between US and China. We can talk about this till the cows come home, but we will never reach any conclusion. So focus on what is within your control. What is within your control? Your risk appetite, your asset allocation, your financial goals. Forget everything else.
So talking about the asset allocation within equities itself, how would you probably rationalize between investing across market caps and across sectors?
So look, and because we are talking to a much larger audience, I would say eventually for most people it's a function of the companies in which they have invested, because I'm cognizant of the fact many of them have invested in stocks directly. Therefore, my biggest word of advice to them would be know your stocks and know thyself. Because if you don't know either of these two, stock market is a very costly place to find out that either you didn't know the stock or you don't know your own risk appetite. From a mutual fund perspective, and that's where we operate, that's the kind of recommendation we give people or suggestions that we give people. Our thoughts flow from valuation. Based on valuation, we have much more comfort in large caps, very limited comfort in the mid and small caps, primarily coming from the valuations at which those companies are trading. they are already factoring in future growth. Now, people keep saying, oh, but growth in India will be the fastest. Yeah, that's true. But then that is already captured in the valuation. You cannot expect that you will buy pricey equities and benefit from growth. That is a bit of a challenge at an aggregate level.
And do you find, are there any sectors that you find appealing at this point, and you think that there are some that could be avoided for an investor to stay, maybe to exercise caution?
So the one sector that we've been calling out through this year, and it still hasn't done anything remarkable, but I'm not surprised by that, is really the whole banking and financial services space. We think core banking is an area which medium to longer term outlook still remains very solid. The balance sheets are in reasonably good shape. So that's an area where we remain quite positive at a sector level. We also think there is increasingly a rise of new businesses in India which are more technology led, or they are playing into some of the critical transitions which are happening in the economy in terms of the energy transition, in terms of clean fuel transitions. And therefore, we run what we call an innovation fund which invests across a lot of the themes in these areas. That is a theme that we think has very long-term attractive potential built into it, even though it is a lot more volatile because of the kind of businesses that we are investing in. So I would say as a sector, banking and finance is maximum comfort. Innovation as a theme, invest, but we would say invest more through the SIP route there, because you're looking at a long-term and a slightly more volatile universe of companies underlying that. The third thing that I would point to, Deepthi, is the last 3.5 years in the stock market, we have seen the dominance of value over quality growth. Given where valuations are and given where we are in the cycle, we think there is likely to be some kind of rotation back into quality growth and away from value. So there are ways to be able to benefit from quality growth, either in the passive space or in the active space. But that's where we would recommend people sort of focus on as compared to what has worked very well in the last 3 years, which has been value.
Do you still find value in sectors like industrials and power, defense, those that have run up recently?
Well, one is the run up in the prices, second is the run up in the valuations. I would argue that in many of these cases, these businesses are trading at valuations where they've already factored in many years of advance in advance of the growth coming through. People point to order books, but I've been there, I've done that, I've seen the entire 2007-2010 period where stocks were trading on the basis of order book, and by the time you got to order book execution, either some execution didn't happen or the stocks dropped their valuation as the execution cycle started to reach its tail off. So I would say be wary of these industrial related stories. We do think in the renewable, clean energy, fossil fuel transition I spoke about earlier, there will be select opportunities, but again, you can never ignore valuation. So I would say in the second area, tread with caution. Industrials, I would tend to be a little skeptical that you can make money from current starting valuation.
Any interesting themes that you probably have seemed to notice, like you mentioned that large caps is something that one should probably look at more closely as compared to small and mid caps. Anything else that excites you?
As I said, and again, just to clarify, large caps is more relative comfort as compared to the other two. But the themes that I would really talk about would be what I said earlier, which is quality growth is where we think the bigger opportunity lies in today's market. There are other sort of, you'll always find in some segments of the market there could be individual stocks, but I'm not sure there is a theme in a sense that I can pull out of that and tell you that there is a big theme over here. Banking is the only other one where I think these are the best balance sheets we've seen going back almost 2 decades, and I think in a country like India, credit is still underpenetrated. Whatever RBI may have concerns about certain consumer credit having grown faster than anticipated, but if I think over a 5-year, 10-year period, I think credit is an industry which will grow much faster than underlying nominal GDP growth. So these starting valuations give you a lot of comfort. Finally, the point that I think people miss on financials is that this is so tightly regulated, it actually makes new entry very, very difficult. Right? I mean, can you get a bank license? Which was the last company which got a bank license? So this is actually a well-regulated area, tightly regulated area. ROEs will not go above a particular level, But this is not a sector which really faces competition in terms of somebody new coming in and being able to compete with them. So I think this is a regulatory moat which exists in financials, and people are missing the attractiveness of that moat at the kind of valuations you're getting to.
So, is there a preference for NBFCs and housing financiers as compared to pure lenders?
Actually, I like all of them, so I'm not finicky at this point. But I think all of them have a lot of headroom to grow.
And is there any mantra that you've followed like throughout your investment, through all your investment strategies over the years?
There's no one mantra, but what I would always say is, look, asset allocation matters, and this is at the investor level, so never lose sight of that. And secondly, as a professional investor, for me, it's always been a question of saying valuation matters. Now, there is no one way in investing which works. There are many ways in investing that works. So the mantra would be that continue practicing what you understand and what you know. Don't try changing your course only because something else appears to be working very well at this point of time. And I think that, to my mind, has been the secret of good investors who have managed to survive cycles. Right? Survival is a greatly underrated strength.
So basically, stick to your style.
Exactly.
And I mean, we've seen this market maven side of you now. We would like to know a little more about what do you do in your spare time? What are the hobbies that you explore?
Well, I mean, one thing that I've always enjoyed a lot is reading, so I continue to do that. Only thing is, I think because now you have such a large volume of audio-visual content, some of my reading time has been diverted into listening to podcasts and conversations on YouTube or other AV templates. The other thing that I enjoyed for many years was actually running. I used to run the marathon, not the full marathon, the half marathon, for almost about 10 or 11 years. But I hurt my foot and I stopped running. But running for me was like meditation, because after a point, because you weren't talking to anybody when you were running, so you weren't getting distracted. After some point, it was only a question of keeping the rhythm of your step and hearing your own breathing, right? Which is as close to meditation, because I've never tried meditation, but to me, running was as close to meditation as I could get. So I completely and thoroughly enjoyed that. And right from my school days, I've always loved playing badminton. So that's something that I keep up with. And a week without 2-3 days of badminton, I feel the itch to sort of get back on court.
That was very interesting, and that was a very interesting tidbit for our viewers as well. Thank you, sir. It was a very insightful conversation.
Thank you.
Thanks for watching, and happy Diwali from Mint.